Good afternoon, everyone, and welcome to today's Dun & Bradstreet webinar. The topic of today's webinar is Impact of COVID-19 on Global Economy. The session will be moderated by Mr. Sam Tidswell-Norrish, International CMO Dun & Bradstreet. Sam leads the marketing and communication function in international business for Dun & Bradstreet. Before I hand over to Sam, wanted to mention few ground rules. All attendees will not have access to talk during the entire length of the webinar to avoid any disruption during the webinar. You may ask your question using the Q&A tab on your screen. We would request you to write your full name and organization name before asking the questions. All questions will be answered during the Q&A session scheduled during the latter part of the webinar. Now, may I please welcome Sam. Over to you, Sam.
Sorry. Thank you, Naina, and it is a great pleasure to be here today for this webinar. You said good afternoon at the start, but it's a morning here. I have my coffee with me at the moment. We're joined today by Dr. Arun Singh, who's the Global Chief Economist at Dun & Bradstreet and is based in India. And we're joined by Abhijit Prasad, who is the Chief Product Officer of Greensill, who's based in London. Welcome both. So today, I've been looking forward to this an enormous amount, largely because it's going to be a great learning exercise for myself and for the audience out there. We're going to have a chance to listen to both of you talk about the impact of COVID-19 on the global economy and businesses respectively. And then we're going to have a chance to ask some Q&A. I know I've already got my questions lined up for each of you. And then once we've gone through those, we'll move over to the audience Q&A as well. It's no surprise that we continue to face unprecedented global risk across the world as the economic impact from this pandemic ripples through economies, businesses, and society as a whole, causing, in many senses, irreparable damage. But it's more important than ever that all of you as business leaders are aware of the risks and can help prepare, mitigate for those risks in your businesses in order to protect your supply chain and ultimately your organization. I can't think of anyone better at Dun & Bradstreet to talk about this to you than Dr. Arun Singh. Dr. Singh has worked across global quantitative and qualitative economic research. He's done economic metric modeling and industry research for over 2 decades. He's provided strategic advice and aided decision making to public and private sectors alike. And his ability to connect economic insight and data to explain what those actionable outcomes are for you is unparalleled. So I'm truly looking forward to it. And today he's going to talk through the top global risks for businesses. He's going to talk through the markets facing the most risk in the industries, and then really the longer term economic outlook. Whilst Arun is the most qualified person I can think of at Dun & Bradstreet, I can't think of a better guest and client to have on this webinar with us than someone from Greensill, an organization who truly knows the ins and outs of the global supply chain and economy better than any other company. And who better to have than Abhijit Prasad? Abhijit's responsible at Greensill for all the product related activities. And that includes everything from the vision to the design, the development, the management, and ultimately to the product marketing of Greensill's products. And all of that really is to ensure that the value they provide to their clients is sustainable. And that's an important word that I think we're probably going to hear a lot today, sustainability. Prior to Greensill, Abhijit was at HSBC in London for 5 years. He was global head of product management. And then prior to that, he was at Citibank in London for 8 years, where he ran supply chain finance for Europe and the Middle East. I'd like to welcome them both. I'd like to welcome all of you, and enough from me because I'm keen to get stuck in. So without further ado, I will hand over to Dr. Arun Singh. Over to you, Arun.
Thanks, Sam. And, welcome everyone to this webinar. And, Sam, as you said that, you used word unprecedented, dented, and that's a clearly defined, and that's the right word used widely across many countries, many geographies. because there's no other word to define this pandemic and to define how critical, how bad it has impacted each and every one. In fact, each country, as of now, we have a data on 190 country, but there are many other countries who, unfortunately, data is not collected at WHO level or IMF level, other macroeconomic parameter. But both all the countries, either directly or indirectly, got impacted. And when we talk about recovery, this recovery depends on the length and the depth of the pandemic, its impact, and that varies from one country to another country. And that's basically, it's very critical that each and every country is unique right from a December 2019, when we started getting some of the information on the pandemic, that there's something happening in one part of the world, and that might create some supply side disruption, that might create an economic issue, that might create a business concern, and certainly, we're talking about the sustainability, that might create a disruption for the sustainability issues. So I'm going to talk about some of the countries and how recovery paths look forward, and how that recovery shape and how recovery scenario can be visible, along with the top 10 risks which everyone should be watchful, because the pandemic is not over. It's over in some of the country, but some of the country where we thought that things have settled down now started resurfacing again, which means the peak is not over for the world, which means we have to be very careful about that. And one divergence, one divergent picture you'll come across many statistics across the world, sources, government sources, multilateral agency sources, service provider sources. If you see, there's many divergence in the parameters they quote about the recovery, about some of the macroeconomic factor, about reality, what's happening. But that happens in all the uncertain and risky environment. That's basically we are facing once in a century. I can't imagine any other scenario worse than this, and when we are, when we are facing, there are multiple level of parameter which gives a mixed picture of recovery, risk, uncertainty. I think we need to rely on a really a reliable source of information that could give a most authentic, and to be very honest, right from the ground, it's coming, on the top. So moving on the, to the today's discussion, if you see, the first thing which completely give a different picture is the stock market. Stock market around the world are showing an upward trend. In some countries such as US and China, the broad market index has recovered from fall, which it witnessed few months back. In countries such as India, Japan, the broad market index is close to the pre-pandemic levels. There are two broad reasons for this, why most of the country on a broad index market, they've reached to the pre-pandemic level, are slightly less than the pre-pandemic reason, because there's two things. One, this movement are largely driven by large companies in that particular country, and second, there's a global stimulus package. In fact, the stimulus package around announced globally, and each and every country have done something. Some of the country went up to 10 to 12% of their GDP size, which is huge, because the GDP itself is huge in size. And on top of that, when they announce stimulus measure, one can understand the government pumping money in the economy. And that was a primary two reason that one can see the stock market surge. But that's slightly different when it comes to the reality on the ground, when it comes to the reality on the GDP front. If you see the GDP data, that's basically, it's a dire straits. And the problem here, the lockdowns, restrictions on various economic activities, stay-at-home orders around the world have impacted the economic activity, especially the manufacturing economic activity. And that one can see the second quarter of 2020, when the concerns around pandemic was at peak level. Now today, the number have not come down, but somehow economies have opened up, China, for example, they went back to their normal. In fact, they rebounded. They registered the positive GDP growth rate against most of our expectation. But look at the GDP contraction in the various countries. India, I mean, we got a couple of days back quarterly GDP data, which is 24% decline, followed by UK at more than 20%. Then you have France and other European nations. So the reason here that you have a one mix of picture, the stock market doing very good because you don't need physical intervention. It's all a digital, and it's all about how, I mean, it's not about how you're working, it's about where you're basically doing the trade. That's one thing. Second, the ground reality, that's the basically manufacturing activity where the basically physical presence required, that's in a negative, that's in the red zone. Some of the parameter, if you see on business optimism, this is basically US and Euro area. Business optimism indicated by various parameters across countries have improved. That going back to the normal is basically the problem which we had in Q2 in terms of the lockdown, in terms of stay-at-home guidelines, that has been eased for many countries. For India, I think we know with Unlock 4 version, almost everything is open except the social gathering and where we have a mass people movement. Most of the other countries have the same approach. And as a result of the businesses are coming back to the normal in terms of anticipation, in terms of expectation, in terms of the optimism. The optimism to reality in our analysis indicate anywhere between 6 months to 9 months. But that's a good part. But now optimism is there, which means next 6 months, one can see the economy going back to what you call not pre-pandemic level, but at least not as bad as what we have seen in the Q2 2020. Some of the unemployment data is what basically everyone has to be watchful, especially at the country level. That's some of the country got impacted, and there is global differences. Most of the country have a very marginal increase, and other countries have a severe increase. But the reason here that has been basically masked by government program, masked by the government intervention at the employment level, masked by government stimulus measures, which is basically, this is a slide. If you see, that's not true. If they're saying unemployment is not very high in some of the countries, but that's basically the stimulus measure in that country was very high. For example, you have a UK example. For there, you have a 3 million people covered in that program, which is 12% of the UK workforce. Basically, you're trying to cover them. One side, you have taken care of unemployment issue in your country. The second side, you're basically putting more pressure on the government finance, which means your future expenditure from the government side will have a serious concern. Unless the private consumption and private investment revive, you will have a problem in those countries. So it's good that the government intervened with the fiscal stimulus measures. The continuation of that might not be sustainable because one, you have a troubled fiscal deficit, you have a troubled government finance, and it will be not fair to ask government to put more money, which means economic activity has to revive to ensure that everything is moving in a sustainable direction. And that's precisely the point. The government across country are easing the lockdown measures in spite of the fact that the risk of COVID-19 have not abated completely. But government have no choice. I mean, economic activity is going back to normal. Of course, social distancing norm, and there are other guidelines which everyone has to follow. Other than that, economic activity has to go to the normal. In that context, I was talking about each and every country is unique. Each and every country follow different roadmap. Each and every country follow different guidelines, criteria. And for that purpose, at DNB, we basically have basically some of the measures, how to rate, how to categorize each and every country into the different bucket. So there are many parameters, there are many pillars we basically look at. In the world, we basically look at something around more than 100 economic parameter for each country. That 100 economic parameter are subcategorized into the 9 sub tiers, 9 pillars to come up with one score for that particular country. That country is basically indicate that how risky that country in order to do trade, in order to put the money, in order to get engaged with the customer or vendor. So basically the first four tier, if you see the bottom, is what we call economic risk, pyramid, what we talk about is all our economic related parameter. The one above, that's in the middle, what we call a commercial risk, which is basically, that talks about the how risky that market in terms of the payment behavior, in terms of the default. And the third is the basically political risk. And all 9 parameters are consolidated in one score. That's basically we rate 1 to 7 score. If you look at that, since January, when we basically got to know that there are basically a problem in the world, we have downgraded more than 115 countries. That's 100 out of 132 countries. We cover 132 countries. Out of that, 115 countries we have downgraded because of the COVID impact, because of the various other ongoing internal problem. And in fact, India is one part of that. But it's the first time, in many months, the first time that upgrades have outnumbered the downgrades. We have upgraded many countries, and in fact, in the month of August, there is a 0 downgrade. We have upgraded something around 15 countries, but downgrade is 0, which means things are improving in those countries, which means things is likely to improve in other countries as well from economic perspective, with the fear, abating, with economic activity restoring, with the government easing the guidelines. I think some of the countries looking good. But that's not that great if you look at from some other countries' perspective, especially in the Middle East and South America. They're still dark. The right-hand side of the chart, if you see the dark red and the black, is basically very risky countries, very risky region to invest, put money from a return perspective. Maybe the company operating in those area might have a payment issue, might default, might create a trouble for the vendor or customer. So that's not easy. That's not basically still there are concerns. And that the lucky part, the 15 to 16 countries have shown that improvement. Going forward, we are expecting more country to improve. But as of date, one can see from this global chart that how many countries are really in the dark shade, which basically represent not a good picture. But that translates to some of our payment behavior of companies in some of the countries. These are some of the examples. We have many. Just for ease of presence, I have basically selected very few countries. If you see across country, the prompt, what you call the share of prompt payment is coming down, and coming down very significantly for Mexico and India. Look at that percentage is very, very concerning, which means if we have a client to trade with, we need to be very cautious about that. Now, moving to top 10 risk, which basically we should be worrying about that. This top 10 risk we put into what you call DNB Global Business Risk Report. And if you look at the index going up, which means it's all-time high in terms of risk since we started capturing this score. The higher the value, which means it's very risky to do the trade in the global framework. What are those 10 risks? To basically, we need to talk about that. One, the impact on sovereign creditworthiness. Basically, your country itself is in a bad shape. There's unprecedented fiscal emergency. There's damaging all grades of sovereign creditworthiness for the medium term. So we need to be very cautious. We need to be very careful about which country is going to be constrained on sovereign creditworthiness. The second is basically protective trade policies. The continuation of protective trade policies, started with the US initially, long time back, before pandemic struck. It puts the additional pressure on the supply chain because most of countries are trying to protect their own trade. The third, the reestablishment of the forced lockdown in the US is going to impact the global demand for goods and services. That could impact the remittance flows, weakening of the recovery, and probably, prolonging the global recession. The fourth is US-China relation. I mean, in fact, it's deteriorating, and there's many issues around that. Unless that resolve, there could be a massive problem on the return, and in fact, there will be geopolitical risk might emanate from that part. The fifth one, the global equity valuation have deteriorated, and it's in fact it's a depressed productivity in the urban areas, and that's adding more to the leading economies. And most of the leading economies might face trouble in going back to the normal in near future. Now the sixth risk is basically unemployment, and I said I basically presented the unemployment data. The unemployment data, what it shows for many countries, is not the true picture because that's masked by many of the government intervention. Once the government intervention withdrawn, some of the countries might have a trouble. The seventh one is basically we have seen the Europe. There's a new wave of COVID-19, especially Spain, France, and other European market, which basically means we have to be very careful about some of those markets. The eighth one is elevated commercial mortgage-backed securities delinquencies rates in the North America, lodging and retail sectors. That might lead to the bankruptcies, and that might delay recovery, and especially for the multinational investors. The ninth one is a failure to contain coronavirus outbreak in the leading copper producing countries like Chile and Peru. That might put pressure on the supply chain. That might put pressure on the pricing of copper. Copper is an input goods for many of the manufacturing machineries, many of the manufacturing entities, which means your productivity is not there, your demand is not there, but the input prices have gone up, putting a pressure on the profitability of a company. And the last, in basically political instability in the Lebanon, and that might encourage the external actors like Hezbollah to take aggressive action against Israel, and that might trigger a regional instability. Because it's not just Lebanon, there are many countries around that might get impacted because of this. Now, what do you mean by that, and what next look like? There are many scenarios. There are the slow burn in terms of the recovery. When we talk about, there are peaks and valleys, then there are fall peak. Each and every scenario has been studied, and most of the country will follow either of this COVID recovery plan or COVID peak plan, which basically lead to 4 different type of scenario for recovery period, which especially U shape, V shape, L shape, and W shape. But there will be regional variation as well. Not all countries will follow the same pattern. Basically, if I'm talking about Asia Pacific, most of the country, India, much talked about that India might have a V-shaped recovery. Most of the other nation might have a W-shaped recovery. When I'm talking about the annual data, when you talk about the quarterly data, we might have a U-shaped recovery, and we might have a W-based recovery because there's a pent-up demand from a Q2 onward that might just emerge, and that put your economy back on the track, and things will look very normal. But that was a one-time demand which was basically not met initially. Now is there. That might erode, and your economy goes back to the same where we quarter 2 data, negative and other territory. So that's what the basically important of the country research. I mean, that's the importance of the country rating, that how each country is different, how each country is unique in order to recovery front. Now, plotting that recovery front to the GDP data of most countries, if you see, most of the countries projected here on annual basis, saying that recovery will look like a V shape. The V shape means is not that it could go back to the pre-pandemic era, but the V shape here means is basically it's not going to have a continued negative growth in 2021. There are many countries, let's say for example, India, one can see that surge is very high, from minus 4.5 to 5% growth in current year to more than 6.5, close to 7% growth next year. Because there's basically some of the countries, they didn't have a structural problem when start of the pandemic. Because for example, India and many other countries, we had seen the incipient sign of green shoot visible during month of January, with many DNB parameter, with many external parameter, that economy is going back to the normal. It's just the COVID impacted those countries. That example is varying for most of nation, that we have to be very cognizant that which country was showing improvement area before the COVID-19, because recovery in those economies will be much faster than the recovery in other economy. Now, just to sum up, there are basic rights. I said that each country will have a different recovery path. Each country will improve in 2021, but the concrete recovery at a global level, what we are expecting, that will happen in only 2022, because it will take something around 2 years from today to go back to the normal level at a world, at a world size, that we are expecting a growth by 2022, not 2021. What do you mean by that to the company? Expect payment delays for, from most of the companies operating in these economies. There will be risk of business failures, which means we have to monitor counterparty risk, and that's very critical from monitoring your own portfolio during this pandemic era. With that, I will close my presentation. Thank you.
Thank you very much indeed, Arun. That was fantastic. And it's fascinating to see that very first chart you showed of the market bouncing back really is illuminating as to just how quickly things did bounce back. But with 115 countries downgraded, it really shows an imbalance and that the economic impact is lagging. But I guess the question really is by how much? And I'm looking forward to asking you a few questions in just a moment. But to our next speaker, and I am really looking forward to hearing from Abhijit. I mentioned earlier that Abhijit is the Chief Product Officer of Greensill, and Greensill has done some fascinating stuff through the pandemic. One of my favorite stories, in fact, was the acquisition Greensill made of the pay as you get as you earn app Earned, which was a digital partnership where they developed a solution to allow NHS and frontline workers to get paid as they earn that money, which was an incredible and generous offer that really saw Greensill move at lightning pace to make it happen. Other things that the Greensill have been up to through the pandemic include the acquisition of a Colombian-based fintech business called Omni, which was part of a strategic plan to unlock a potential $750 billion in working capital finance in Latin America. And recently as well in the UK, Greensill was approved by the British Business Bank as a new accredited lender to provide invoice finance through the coronavirus large business interruption scheme. So it's been a busy time for Greensill. I know that Abhijit today has got a number of areas he'd like to discuss. If you have questions, put them in the box and we'll ask them at the end. But for now, over to you, Abhijit.
Thank you, Sam. And Dr. Singh, it was a very interesting presentation, and you kind of covered the macroeconomic effects of COVID. What I'd like to focus on is talk about how we see the world from Greensill, and specifically around supply chains. But maybe quick introduction about Greensill. And our kind of vision is making finance fairer. And it's at a time when I believe businesses, governments, people need access to finance and cash more than ever before. We're different to the traditional banking sector. We are powered by financial technology, but actually we've got a very deep expertise of credit management, and we use data as much as we can to accelerate the movement of capital to where it's needed the most at the heart of the economy. And as I'll talk about a little bit today, and Sam has mentioned, we're on a mission to revolutionize how we work, how everybody gets paid, and we see a world of where there's equal access to finance and capital, and where no one should have to wait to get paid. Can we move to the next slide, please? So who are we? We were established in 2011 after the global financial crisis. So actually, a lot of us who work at Greensill have actually seen what the previous crisis was, and I'll talk a little bit about that as to the similarities that we see in the two crises. And we were set up to provide working capital to large corporates and their suppliers around the world. And we provided access to, as you can see from the figures, a large number of suppliers and corporates around the world, most of them SMEs. We financed over $140 billion in 2019. We've got over 100 institutional investors, which are made up of banks, fixed income investors, and so on. And we've had a couple of equity investments. We're powered by technology, as I said, and we specialize in supply chain finance, which provides access to people and businesses, which is faster, cheaper, and fairer than the most traditional alternatives of banks. And our fundamental principle that we apply across all our financing is that we try to use the most efficient point in the supply chain to attach ourselves. And that's where we use, if it's a large corporate with suppliers, we use the large corporate to finance. If it's a large corporate with customers or distributors, we use that large corporate. So we try to use the most efficient point in the supply chain and provide finance on the back of that. And I'll talk about this a little bit later. The other key innovation that we've brought is make this asset class, which is a trade finance asset, which has traditionally sat with banks, and we've kind of democratized that and made it accessible to capital markets. So you've got fixed income investors who traditionally did not have access to this asset class who are now investing. And that gives us scale like no other bank can have. Can we move to the next slide, please? So again, just a quick summary of what we do. We provide structured working capital solutions, whether it is on the purchasing side, on the sales side, on the inventory side. So all our kind of solutions are structured around trying to optimize working capital, which we believe is the lifeline of any company. And recently we've kind of, as Sam mentioned, we ventured into another space, which I'll talk about a little bit later, but I think that's close to heart to definitely me, but also as individuals to all of us, which is how we get paid. And we see this as a revolution that we want to kind of bring around the world as to how people get paid. So Sam mentioned we made a couple of acquisitions. They're kind of there on the screen for you to see, but I think that's enough about Greensill. And let's start talking about what's actually happening in the world today. So can we move to the next slide, please? So Dr. Arun Singh talked about the troubling times and these unprecedented times that we've seen, where it's a shock to the system like I think we've not seen, at least in my lifetime, we've not seen this. Financially, what does this mean? Companies are finding it increasingly difficult to borrow. Obviously, top lines of companies are being seriously affected. They're finding it difficult to source their goods and services, and we are seeing companies which are finding it difficult to kind of make their own budgets and meet their cash flow requirements. And of course, companies which can adapt and live through this, as Dr. Singh pointed out, we hope that companies can survive this so that they can kind of go up the V or W recovery chain. But as I'll talk about, in our view and from our experience from the past crises, we believe this was on the way down, right? So things were going worse. Actually, in our experience, the real strain comes on supply chains when actually things start to improve, and I'll talk about that in a minute. So if we can move to the next slide, and that's the one I'd like to focus on and spend a lot of time on. And we really see this as as a triple whammy in supply chains. And some of you may have heard of this concept of this bullwhip effect. It's a term which has been commonly used in supply chains. It's a distribution channel phenomena, which basically means the further you are away from the consumer, the end consumer, the propensity for orders to be more variable than the actual demand is higher as you move away from the end consumer. Which basically means, if you look at this cartoon on the left side of the slide, you've got the end consumer who's kind of ordering, some goods, and there's retailers who the end consumer would buy it from. There are manufacturers, there are suppliers, and obviously there's, this is a simple good that we're talking about, toilet paper. But as the good can change, it becomes a more complex good. The actual suppliers can be multiple hierarchy of suppliers. You could have 3, 4, 5 layers of suppliers there. And as you move away from the end customer, even small changes in demand from an end consumer actually amplifies as it moves further away. And you see this effect as demand slows. There'll be a lowering of orders down the chain. And as demand increases, there is an increase in orders. And so your customer to retailer, the retailer actually knows exactly what's happening from customers, but there'll be a buffer that they will apply there. The retailers to manufacturers, there's a further buffer and kind of, incentive to apply some more buffer there. Manufacturers to suppliers, larger suppliers to smaller suppliers, SMEs, and down to kind of individuals. And the challenge with this is, you consider what happens as we start coming out of this pandemic. Let's say I'm a manufacturer and I was sourcing from a supplier. I was ordering, let's say 100 worth of goods. As my demand starts increasing at the front end, right? So as customers start increasing, the demand starts going up. The amplified effect of this bullwhip effectively means that as the orders come to me, instead of supply of 100 that I was providing to my manufacturer, I will now be asked for 200. Right? So suddenly my orders start going up, and they actually start expanding quite rapidly, even though demand has kind of moved slowly. Now you combine this with the second fact, which is the second kind of figure in the middle of the slide, which is extended payment terms. And Dr. Singh referred to that as well, right? Prompt payment, how that is kind of reduced. Across the world, you will see larger companies wanting to pay later and later. Now think about it from a supplier's point of view. I've got an increased order, right? I was supplying 100, and let's say I had a 30-day payment term with my manufacturer. Now my manufacturer is asking me for 200, and they're asking to push that payment out to 60 days. Think of what happens to that supplier and their financial condition. They've got to effectively finance double that amount for a longer period of time. You kind of include into that the fact that you've got limited access to finance, and you can just see this as a complete disaster for what happens to supply chains. So where companies had limited access to finance, and as the COVID crisis is actually we've not yet come out of the crisis, right? So the access to finance is still very limited. SMEs' access to finance in any case is very poor. Any crisis that hits, the first people that get affected are the smallest people in the chain. So the access to finance to smaller companies actually goes off the quickest. Whereas those are the ones who get pushed the most, and those are the kind of players who bear the brunt of what actually is happening in the economy. And so this triple whammy of this bullwhip effect, as you start coming out of a crisis, the fact that you've got larger companies who will effectively want to pay later and later, and they will either do this by explicitly extending terms or without kind of informing, start paying late, as Dr. Singh referred to in his presentation. And then you combine that with the fact that suppliers actually have no access to finance. and that's when companies go bust, and that's when companies kind of collapse. And we've seen this. I mean, for those of us who lived through the financial crisis in the West, we've seen the number of defaults and companies going under as we started coming out of the financial crisis. That's when actually companies start going bust, and that's the thing that we are concerned about. That as we start coming out of, as the recovery curve starts coming on, companies are going to be put at an increased amount of stress, and this is what we exist for. The purpose of Greensill is to support companies, and therefore the products that we've got are designed to kind of support that. So if we can kind of move to the next slide, and I'll talk about that in a bit. Next slide, please. Yeah. So there is a concept called supply chain finance, which some of you may have heard of, and I've referenced that. It is using is large companies using the strength of their balance sheet, of the size of the company to support suppliers in their supply chain. Now, traditionally, this is an offering which has been dominated by banks, but the kind of supply chain that they have supported traditionally has been a very narrow supply chain. It has not been the entire supply chain. Most companies, large companies, have got thousands of suppliers. The bulk of their purchases are in the big suppliers, but there are a large number of small suppliers that most companies have. And most banks actually have not supported these kind of smaller suppliers, whereas they're okay to support the large ones because economically it's not made sense for them. We don't see the value of supply chain unless you can actually support the small guy and you can actually support the smallest suppliers. And that's what we've designed our products for, is to support not only the largest suppliers, not only the medium-sized suppliers, but the smallest guys who are actually at the receiving end, as we talked about, of the crisis. And so our programs are designed to effectively support all suppliers of corporates, and we do this across the world using technology and data to do so. The last thing that I'd like to talk to you about, and if you can move to the next slide, please, is, as I talked about, we see a future where no one should have to get paid, whether that is a supplier, whether that is a large company, and indeed whether that is an individual. And that is, if you think about each one of us who work for companies, at the end of the day, we are also a supplier to our employers. All of us work for 30 days in the month, and then we get paid at the end of the month. And therefore, we are effectively providing implicit credit. We've provided the service that we've been kind of hired for, but we only get paid once in a month. And if you think about what that means that we are effectively providing credit to all our employers. And there are about 3.5 billion workers in the world today. About 52% of them get paid a salary. That's about close to 2 billion people in the world who have to wait for their money after they've provided the service. And we really feel that is an antiquated way of how people should get paid. And we believe that people should have access to their money, and it is your money. After you've finished your day of work today, it's actually your money. You should get paid, and that's what we believe. And that's what Sam referenced as our earned kind of proposition and product. And that's what we're doing. What's actually happening with individuals and employees? If you can move to the next slide. The current pay system, if you look at what's actually happening to individuals, especially with COVID, money worries are the primary concern for every individual. And this is kind of across the board, several surveys that we've done, and they cause anxiety, stress. They can force them, depending on where you are, you can force them into all kinds of, payday lending schemes and credit schemes, which are extremely highly priced, while they wait for their money to be paid at the end of the month. This has got an implication for businesses as well. Can you move to the next slide? And this is us, right? Businesses and you and your companies. Next slide, please. The issue for businesses is that it not only is an issue for their employees, but it actually costs the businesses. A stressed employee is not a good employee. No business wants to be seen to treat its suppliers and employees poorly or unfairly, and it can cause a huge drain on productivity, reputation, less profit, all the sort of things which are not good. And so our view is we need to provide the same service that we provide for corporates. We are now providing for individuals, so that we can have people paid as soon as they get paid, as soon as they want. So after you finish your day's work, if you move to the next slide, we'll show you what we see this as. Next slide, please. So think of a situation where after you've done your day's work, you have access to an app where you can say, actually, I want to get drawdown, or you want to set that up so that every day as I finish my work, I get paid. Or if you don't want to get paid, you accumulate your cash and you can see that as your earnings, and you draw down on it as soon as you kind of finish. And that's where we see the world moving. And actually, that's where we see everybody actually across the board, whether it's corporates, businesses, we don't see there's a need for anybody to kind of wait to get paid, as we believe that's kind of unfair, and it always pushes the pressure on the smallest person in the chain. With that, I kind of finish. Hopefully I'm good on time, Sam, but that's it from me.
Thank you so much, Abhijit. And I've got a personal passion in this space, and as an investor in an organization that does the business to consumer advancing, it really is such a necessary foundational component of the economy ultimately. And the fact that whether you're an SME or you're an employee and you're getting paid on 30-day, 60-day, 90-day pay cycles, you're effectively loaning the person above you in the value chain that money on that cycle. And for an employee to loan an employer their salary for 30 days is ridiculous, frankly. So the work you're doing is exceptional. Thank you so much. And there were a number of points in that presentation that I thought were fascinating. Firstly, the scale of Greensill is something that blows my mind. I know with $149 billion financed last year, your aspirations this year are substantially higher than that, and your growth trajectory is frankly incredible. I love the fact that you're such a data-enabled firm, using data and through the Dun & Bradstreet partnership to ensure that you're mitigating risk, but you're also pinpointing where capital needs to go most. And that, I think, is a really altruistic component of Greensill. And then finally, my favorite slide on that, in fact, was triple slide. And I've never heard of the bullwhip effect across the value chain, from consumer to retailer to manufacturer to supplier. And that really brought to life the ripple effect that just a simple action from a consumer can have across the value chain. I've got a couple questions myself, and then we'll move to the Q&A. Abhijit, I'd like to start with you, if that's okay. What industries do you think are best for supply chain finance? Where would the application be most powerful?
Yes, Sam. So, I think we've got clients across the entire industry spectrum, so right from governments, which do all kinds of sourcing, to industrials, to telecom companies, to retailers. And if you just think of that slide with the bullwhip, right, where you see the consumer with a retailer, a manufacturer, a supplier, any industry where this chain exists, and actually the longer the chain, the bigger the effect is likely to be of the bullwhip. You can think of the application of SCF there, right, where you can use the strength of the larger guy to help support the smaller people in the chain, whether it is, to be frank, whether it's customers or suppliers. we use the principles both ways, but anywhere where there is, a deep supply chain, that's where the application is really apparent. The other kind of thing to think about is the stronger single counterparties. So governments are typically strong counterparties. And so those governments, so we've seen, for example, as you mentioned already, NHS, we support the National Health Service in the UK for all their 11,000 pharmacies who get paid on a monthly basis. And they actually get paid significantly before they would have had they not used our service. And at a price which is, completely unheard of for the small pharmacies, because we can use the government credit to support that access. So wherever you've got strong counterparties and deep supply chains, we see the application of those of SCF very strongly in those industries.
And tell me, other than just supporting a supplier by working with Greensill, what other benefits might a corporate get? And I've been thinking about this question in the context of the employee and the employer, but from a B2B side, what are the benefits that corporates get by offering a supply chain finance program to their suppliers?
Yeah. Now, of course, you're kind of helping yourself, because if you've got strategic suppliers, important suppliers, you don't want to kind of run out of business. You don't have to worry about sourcing another supplier. So just by making sure that there's enough liquidity in your supply chain, you're actually supporting yourself. But more than that, you're actually you're doing something which is socially good and responsible. You're using the strength of your own company to support suppliers, individuals possibly. You actually become a preferred customer to the supplier. If you think of a situation where you've got a supplier who's got the option of supplying to multiple customers, they'd always go to somebody who actually gives them an option to get paid early. So you actually become a preferred supplier. Actually, there've been cases I've seen in my career where certain TV manufacturers had access to panels with the TV manufacturer that which provided a supply chain solution, whereas one which didn't. And in the World Cup, where we're kind of, that's one case where TV sales shoot through the roof, they were able to meet their supply for LCD panels because they were able to offer a supply chain solution, and they become a preferred customer for their suppliers. And so it's a very interesting way of becoming somebody who suppliers want to work with. And it completely eases the tension that exists between normal discussion that happens between buyers and suppliers. Buyers want to pay late, suppliers want to get paid early. If you can de-link that completely by offering this solution, you take out the stress in that conversation. And in almost all cases, we've seen the actual relationship between buyers and suppliers significantly improves because of these programs.
Okay, thank you, Abhijit. And Arun, over to you. I've been thinking a lot about, while you were talking, all those people that we serve as Dun & Bradstreet. We have a lot of credit and finance leaders that we spent a lot of time with through this recession. I know one of the programs we've spent time on through the pandemic is the CFO Club, where we speak to CFOs in blog and op-ed formats and podcasts to understand what they're going through in this recession. You talked about increasing risk of delayed payments and business failures. So in that context, what would be your advice to credit and finance leaders to overcome the recession?
Yeah, thanks, Sam, for that question. So, if you see today, in fact, even historically, there's many learning we have, and we talk about the Great Recession, we talk about 1999 Asian financial crisis, and then dot-com bubble. Every crisis have some uniqueness, and they basically teach today what is required, that each finance and credit professionals, they have to be basically flexible and the forward thinking about what they can do better to manage their cash flow during this economic downturn. They are doing already, but what's required at this point of time, they need to do more of the same thing in a two different approach. One, basically they consider supply chain data. It's not enough, in fact, to know the financial strength of your customer. That you now need to know the financial health of the suppliers or vendors or customer. In fact, you need to know the entire supply chain, health of the entire supply chain, right from the origin to you, because one weak link might disrupt anything, and that you need to know. In fact, we talked about the DNB COVID impact index. That is basically a tool for the professional to manage that, because it will create a full ecosystem of your supply chain and map each company, that company is on how risky or how non-risky that vendors to do the trade with. That's one. The point number two, now perform ongoing portfolio management, which basically being notified of deteriorating credit scores and the legal events is important. We should do that. Setting up alerts for credit risk monitoring can be a very crucial at this point of time, particularly if changes will have a material or in fact called financial impact of your business and your sustainable growth front. We have tools like DNB Credit, where basically company can leverage on that. So these two things I would advise that each finance and credit professional should be doing more of these things.
Thanks very, very much indeed, Arun. I've got a couple questions that are popping up in the Q&A, and one of them makes me smile, because not only do I know the answer to it, but I know that the man leading the charge there. Abhijit, is Greensill operational in India? And I assume the person's asking that because they love what you've been talking about.
Yes. So the answer is yes. We are. We have actually incorporated as of a few months ago, I think, and we are in the process of obtaining our license, which we expect to get by the end of this year, and then we'll be we'll be kind of live locally for local flows in India. We are already doing stuff supporting buyers and suppliers for the export and import business. So yes, we are very much live, and whoever has asked the question, if they're keen to kind of follow up, please feel free to reach out to me, and I can connect you to the right people.
Thank you very much. And then another question that's been put up, and I think it's an important one to differentiate. How is Earned as a solution different to a credit card?
Now, I think the most fundamental difference is as an individual, Earned is not a credit. Earned is not credit. Earned is about having what is yours the moment you've earned it. So the concept of Earned is, if I've done 10 days of work, the first 10 days of the month, the pay for that is mine, and that should be available to me as soon as I've completed that. In fact, the moment I've done 1 day of work, I should be able to get access to that. So first of all, it's not credit. It's making access to cash available directly to employees the moment they've earned it. Credit cards obviously very, very different, where you're taking credit from an institution. It's not your money. You've effectively taken a loan. So I think that is the most fundamental difference in the way we see Earned and credit cards. Does that answer the question, Sam?
It certainly does, and I think the fact that it's not credit is really the crux of it. I have a couple more questions. I had another question for Arun, in fact. What short-term and long-term supply chain trends do you see, or do you anticipate, I should probably say, after the COVID-19 crisis subsides? What are the ripple effects further out that we can't yet see?
Yeah. Thank you, Sam. In fact, if you see what's happening today, in fact, the reliance on the single destination sourcing for most of the companies has exposed, and that put them into a big trouble. And that's happening. I have seen that if you are basically reliant on particular set of categories, particular set of vendor, and that have exposed, and that exposure was quite bad. In the short term, as we basically as a company scramble to identify alternate vendor, the trend of multi-sourcing will increase rapidly. That's the one thing I think is expected from, in fact, that started already. It's basically that will become a new normal. In the long term, we envisage an overhaul of the global supply chain. When I say overhaul of the global supply chain, I've been talking about this subject since start of the lockdown in most of the countries, that there will be global realignment of many countries to have a policy negotiation with many of their trade partners, with the free trade agreement, with some other things, some of the abolishing some of the free trade stuff, policy level. There will be intervention happening with the multilateral agencies. There will be a government intervention happening in order to have that level of what you call, realignment of their sourcing, which means basically setting up a manufacturing plant, setting up warehouses, setting up various other units related to supply chain, to ensure that their basically supply chain are intact and secure even in the this type of crisis, because this is a learning for everyone. We never thought about the impact of such such risk, but this happened and now people are troubled. So that could be the second front. The countries in fact will have the priority to secure their national interest. Economic policies I was talking about will be rolled out to increase their domestic manufacturing and nearshoring of the critical goods. The two things: one, they will increase the vendor and they will increase the supplier across the world. And the second thing is that I think most of the country will try to promote their own domestic industry, and most probably they will go with the nearshoring of the goods rather than relying on other company based on some other country. So these two things I'm expecting that will have a new normal during post-COVID era.
Thanks very much, Arun. And I think we've got time for one more question, and it's an interesting one. It's one for Abhijit. And Rajesh has put in the comments box, normal banks shy away from the field of supply chain finance. And I mean, I think that's potentially not entirely true, given many of the larger banks have enormous supply chain finance businesses. In fact, I think, Abhijit, that's probably where you met Lex at Citi, I'm sure. Is that entirely true that normal banks shy away from it? And the second part of the question is this like an ESCO?
I didn't get the second question. Is it like an
ESCO, ESCO?
I actually don't know what that means. Are we talking about ESCO?
Let's focus on the first part of the question.
Let's focus on the first question. So clearly, I think you're right that big banks, they don't shy away from it. They obviously do this business in scale and in many markets. What they do shy away from is dealing with the entire supply chain. So they want to deal with the top 10, top 20, top 30 suppliers of corporates. They actually don't want to deal with the thousands of small suppliers that exist, because it is onerous, painful for them to deal with that, because the use of technology, the use of data is not as prevalent in large banks. What we can do, and that's, I think, a differentiator for us, is we actually offer a supply chain. And whenever we offer to a corporate, we offer to their entire supply chain. We don't set thresholds to say, actually, you can only support a supplier who's got a spend of only X dollars or whatever, right? So we offer this to everybody, because we strongly believe that the real benefit of supply chain actually is to the small people. If you can't offer to the small guys, then what you're doing is just, it's a big boys club, right? You actually want to, the value of this is if you can offer it to the small suppliers. And so I think the question from Rajesh, I think you said, is true in the sense that the big banks shy away from supporting what we call truly, widespread supply chain program. They probably offer it to a handful of suppliers.
And so I think the Greensill approach is hugely admirable, supporting the whole value chain. But if you're integrated across the whole value chain, do you not expose yourself to substantially more risk?
I mean, that's the beauty of supply chain. I think the risk is not any different. The risk is you continue to take the risk of the big corporate. You're just using technology to make sure that you have that you're able to onboard large number of suppliers. You have access to finance, which is incremental and above what a normal corporate would have through their bank line. So you're making new capital available through the fixed income and capital markets to this space, which they would not have otherwise. And therefore, it's really something which corporates love, because they're not eating up their bank lines to do something like this. They're actually providing incremental liquidity, which they didn't have access to, and providing it to the entire supply chain. So it's kind of a proposition which we find very few corporates say no to.
Fantastic. Well, Abhijit, thank you. And we're going to end it there. It's been a wonderful discussion. It really has. Thank you so much, Abhijit, for joining us as, well, firstly, a wonderful guest, but also secondly, as an enormously valued client of Dun & Bradstreet. It's been a real pleasure. And Arun, it's always a pleasure talking to you. I'm never short of learning something when we do. Thank you very much indeed. For those listening, we will be providing a recording of this presentation, and you'll have it in your inboxes in no time. If we can ever help with anything, both on the Greensill side or the Dun & Bradstreet side, please don't hesitate to get in touch, and you can find out details on our respective websites. Thank you very much indeed, and we look forward to seeing you all soon.
Thank you.
Thank you. Thank you.
Bye.